Welcome to the Bank of Life podcast. I'm your host, James Neathery. I'm excited about today's show, even though it's not a long form episode. What we've done, we've gone back and taken clips from previously released episodes on particular topics and points. I think they're powerful. I think they're worth listening to. So thank you for listening, and hope you enjoy. What other, financial endeavors do you engage in that continually get better and better? So.
Well, yeah, it's ironic you should say that because, obviously, I spent 37 years working, for the electric distribution company here in Houston. And obviously I was part of participating in the 401k process. And so you look at, James, the stock market today, and, you can kind of see where it is headed south. You look at the banking today.
Oh, yeah. Let me just say that we're recording this on the 16th of March. And so all of these banks have just, 4 or 5 of them have, 3 of them for sure. And, have collapsed. And so I just want to interject that kind of time frame.
Yeah. So, yes, great point. And so what's so ironic about this, James, is I received a call yesterday. And as you know, I've got 8 kids. So, and so it's my 27-year-old daughter. Yesterday, Wednesday, she calls me, and she calls me from work. She goes to school. She still goes to school, but she's also works full time as a carrier for USPS. So she's a mail carrier, and so she calls me. She says, "Dad, let's talk Silicon. Let's talk banking for a second." So I says, "Okay, let's talk banking." So she says, "So I'm out here working hard and trying to do good with my money." She says, "Where in the world She said, "Where in the world does a girl go just put her money and it keeps?" And it stays safe. She can safely keep her money. And I thought about, all the times, that I still, as I said in that first podcast, my family and I were still tight knit, and we still have what we call a state of the Whitfield family discussion. So they all come home and we sit down, we have meetings. And I've introduced them to the IBC concept every chance I get. But sometimes, James, it's kind of like you hear, but you don't hear. and so I then begin to say, well, dear, the infinite banking concept that we talk about during our meetings, I said, you can kind of see now where the safety it provides comes in. It's a safeguard. It's guardrails for current situations that we see happening with the banking today. So it's a safe place where you can save your money without being worried about. Am I going to lose it? Am I going to lose more this month than last month? Or, those kind of situations. So it's almost like the light bulb went off for her again. She says, "Oh, yeah, we have been talking about that. You've been mentioning that." And so I began to tell her there again about the IBC process. And if you have money, especially savings, don't take it out and stick it under a mattress. Don't do that because you're losing. But you should consider the infinite banking concept and whole life insurance policy, and then saving that money within that policy, and the power of the insurance is that's the other thing we kind of talked about too, James, was the differences between a bank and an insurance company. It's difference between, even the way they handle the money, the banking. I told her, I says, every deposit you make, that bank can take that money, that paycheck that you deposit, and they can turn around and loan that out up to 10 times the value you put in there. She says, well, where do they get that money from? I says, they don't have it. The money is just created out of thin air.
So I wanted to reevaluate, and I thought, man, the only things I ever really talk about at length and I can talk about, and nerd out on would be infinite banking, because I've been doing that since 2010.
Okay. Well, I mean, don't skip over that.
Yeah,
Very interested in how, and I'm sure the listeners would be too, how you even got exposed to that, and just that whole story.
Yeah.
I mean, don't start in 2014 and then bring up infinite banking 4 years earlier.
I mean, usually I'm pretty good at being chronological, but
yeah, I mean, your military got so
yeah. Let's go back to 2010. I had just come back from living overseas for 4 years. I wasn't a big investment guy. I didn't know much about money. I didn't spend a lot of time trying to learn about it. So I just saved, and I had a lot of money saved up.
Like in the brick and mortar bank or whatever.
Yep, exactly. In somebody else's bank.
Personal.
Yeah. Okay. I had some money in the stock market because I didn't know what else to do with it. So somebody introduced me to this little book called Becoming Your Own Banker by Nelson Nash. And I read the book, and then it took, I'm not the quickest guy, not like Paul over here who got it instantly. I read the book, and then I had a conversation for about 6 months over email with a guy who was introducing this to me, an agent. And finally, I caught it. It took me a while. I caught it and got policies on the kids I had at the time and the wife. And so it started with 3 policies. I couldn't get insured because of my avocation. Yep. What I was doing in active duty.
Yeah,
when I was flying.
Not necessarily active duty.
Yeah, so we
attack
right.
pilot.
Yeah, life insurance companies for some reason didn't think that was the safest thing in the world. Yeah. I don't know. I always felt safe.
But it's an A-10.
Yeah.
You can eject.
You can.
Like a helicopter, right?
Yeah, no. Helicopter, no, I like it. I like having a parachute.
Okay, so we'll is that good?
Yeah, so that was started my journey, and I just used that as a savings account. But when I got out of corporate America and started doing my own real estate stuff, I started flipping houses. That's the first time I realized, hey, I've actually got this big warehouse of capital right there, and I control the terms on that. I'm going to use that to fund the rehabs.
Been paying premiums for 8 years.
Yeah. I've been stockpiling that. And that was kind of actually I had a goal. I needed a certain amount before I left my corporate job. Mm-hmm. So my family wouldn't suffer. If I didn't make any money for the next year, I'd have enough for us to live comfortably. Yeah. But I ended up using it to flip houses and actually got to see it in action. Taking the loans against my cash value, not having to repay them because that 2-month flip, right? I'm going to be in and out 2 months, no big deal. It's my first one. 9 months later, finally sold it, lost $11,000.
What? No profit?
No profit. Learned a lot.
Is that $11,000 counting your time?
That was just strictly dollars.
That's a no.
Yeah, right. That did not include any of my time, but it was an education.
Yeah, we all pay for that.
And I never lost money on another flip after that.
Yeah, perfect.
But that was my first introduction to how powerful this tool is and this concept that I got to see it in action. And then I started in 2018, like I said, I was like, I love talking about it. I tell people about it all the time. Why don't I just try to build a business around it so I can actually tell more people? Yeah, I gotcha. That's what I've been doing for the last 5, going on 6 years now.
Perfect.
Yeah.
Well, Paul, tell us about yourself and then how it all started, y'all's connection, all that.
Well, I'd just like to thank my mother. No. So Paul Fugere. It means fern in French. I found that out later in life, actually.
Love fern?
I don't know if it's a love fern, but
just an Italian fern?
No, French fern.
Just French fern.
Regular fern, I guess. But no, always interested in money ever since I was a kid. Always knew I wanted to get into finance after my Army career. And then an opportunity arose to get into the infinite banking concept business. I was Dave's first client.
No way.
Yeah.
Yep.
Okay.
Yep. Did not read Nelson's book. I read The Case for IBC, actually, was my first book.
Well, Nelson was co-author.
And he co-authored it, right. And and Tammy will attest to this, but I remember reading this book and I'm kind of swearing to myself reading this, like, why didn't I know about this 15 years ago, right? And then immediately I had owned regular whole life, non-participating since I was a second lieutenant, so 2003. So paying premium, not enough, but moved all those old policies over.
Like 2019, is this?
Yeah, this is
Early 20. It was
late 2018, early
Right.
2019.
Okay.
Went into underwriting in 2018, and policies were issued first quarter 2019. And I just made the 6th premium on all 4 of those policies. So, and they're phenomenal.
Did you hesitate writing that premium? Did you have to think about it?
No. So my premiums increased. I went from they increased about 37-fold.
Ooh.
Actually. Yeah, 37 times the amount of premium I was paying.
Oh, compared to the non-par, non-participating? Yeah.
Yep. No. And I still don't hesitate. And I still want to write more. Pay more premium, right? The problem's the problem, right, James? The premium's the solution.
There's never a problem until there is one. So you've used the infinite banking concept, in your real estate, you use it kind of like a line of credit, just the access to capital. So if you, like on a fix and flip, there's of course, a purchase price, and then there's all of the cost to getting it ready to flip. And when you did deals like that, how did you address your loan repayments? You paid premium to create the cash value that you can leverage, collateralize to go buy the property. Did you have a system, or have you developed a system where? And so my question is maybe more narrow. Whenever you did a fix and flip, did you set payments up, loan repayments between the purchase, the repairs, and then flipping, or did you just do lump sum?
Lump sums. So I would pull the cash out, and then once the house was sold, like flipped, sold, then I'd pay it all back in one lump sum. And I was very intentional about making sure I always paid it back.
Yeah.
And rinse and repeat. And
then now on a buy and hold, I think you said you've used it for down payments, right? So do you, it is none of my business, and you don't have to share anything that you don't want to, right?
Yeah.
Do you use, and you mentioned hard money lenders, and I get that on flips, without it, it's just part of the deal a lot of the times. But when you buy and hold, are you using conventional third-party lenders or hard money lenders, or what does that kind of look like?
Yeah. So typically in the past, I would always have flips going on, and then simultaneously I would be buying buying holds. And with this one, I always had private money, and then I would use my insurance policy to either put the down payment, or if I needed to do some repairs, and that way I could get a tenant in. So I would do it that way. But since I actively had flips, I always used that capital to pay that off. And so that was the beauty of kind of doing both of them at the same time.
I gotcha. And then with your buy and hold, do you how do you address, or have you created an idea or a form? It's really form to cash flow is kind of what I call it. But what do you do with repairs and insurance and taxes? Do you use your policies for any of that, or?
No, to be honest, I don't use my policy for that. I think I really look at my policy as just liquid cash in a sense, and I use it to acquire the properties, do quick repairs, and then pay it right back, and then move on to the next one and use my policy just
I got it.
Yep.
I mean, you keep accumulating real estate, and the tax bills are going to continue to go. They're going to continue to go up anyway.
Yes.
But it'll be on an exponential curve with more properties. Same as insurance in Texas, OMG. And then, the repairs are what they are. So, and I ask that because everybody does something different. You walk into a room full of 100 different people, and they're going to be doing 120 different things.
That's right.
And then their perspective and their activities change, just like it's part of life. And so it's very interesting to me the way people use their policies, and like I said, that changes over, time.
Yeah, and I would say even to that point, I think that's also the beauty of having this infinite banking system is you can have 100 individuals using it 100 different ways. Mm-hmm. You can't say that about a lot of other loan products specifically, right? So even when you go down the hard money, it's either it's for a new build and you have to use it for a new build, mm-hmm. and you have to show that you're using it to build. There's disbursements and you have to prove what the disbursement is for. And so that's the luxury and the beauty of this system is you can have 100 people using it 100 different ways. And that's great.
Yep. And you can get mad and change your mind how you want to do things.
That's right.
If you can control the cash flow, if you can control the banking function, is it absolutely what it is. That's what becoming your own banker is all about. The infinite banking concept is who is controlling the banking function, because it exists, period. It's the oldest profession in the world. I did a little solo on that. And it's the most profitable business in the world. And either I'm saying something and she's, describing things that, we're either out in left field and just, talking about this thing on a podcast, or there may be something here that you might want to learn about, and then Nelson Nash, the creator of the Infinite Banking Concept, the author of the book, Becoming Your Own Banker, he said everyone should be in two businesses. Whatever it is you do for a living, and then you should finance that. So, and I completely agree. As you pay a premium to a life insurance company, when you're practicing the infinite banking concept, the premium has specific places, or you're buying specific things whenever you pay a life insurance premium. Number one, it comes with a death benefit and all the other riders that you're purchasing, whatever they may be, term, spousal term, guaranteed option to purchase more death benefit in the future without underwriting. There could be, what do they call accelerated death benefits or nursing home benefits. Most of them will have a premium for that benefit. Some don't have a premium for that benefit. The cost in that case would be at the time of use. Okay. But part of that premium that's being paid, in addition to the term and all the riders, which term is a rider, a portion of that is going to be paid into the paid up additions rider. There's a fee. The fees vary across the board to when you pay a premium into the paid up additions rider. There's a fee associated with that, no question. And then there's a base premium, which is you're buying a whole life policy, which is called the base whole life policy. And then you're putting these riders on there. Okay. Now, so there is a fee whenever you pay a PUA premium. And as you pay more PUA premium, the cash value is greater and greater, because the majority of that PUA premium goes to cash, less the fee. So if the fee is, if I put in $10,000 as an example, I pay $10,000 into a policy, I'm paying $10,000 paid up additions rider premium. Maybe there's a 5% charge. That 5% is a charge. It's deducted because I'm buying something with that, right? Then that $9,500 roughly becomes cash. Well, in my example, it would. $9,500 would be cash. Okay. That additional $9,500 in cash value causes the future dividends beginning this year, the year that I paid the $10,000 in premium in my example, and every future year, you caused the dividends to go up. Was there a cost? Yes. Were there benefits? Yes, yes, and yes. Okay, so I'm not jumping over the cost. But let's say that next year, I want to withdraw money from the PUA. And I'm not saying that the charge on the PUA, let's say it's 5 and maybe you have a 5% dividend. I'm not saying that that's a wash. I'm not saying that at all, and which is another, spend the whole episode on that. Dividend interest rates, loan interest rates, and charges to on policies. But the bottom line is this. There's going to be that cash value of $9,500 net of the fee from the PUA premium payment is going to be larger next year because there's a guarantee increase in cash value each year. So that value is going to go up. And then that premium caused the dividend to be higher compared to me not paying the additional $10,000 in PUA. So that $9,500 is going to be greater. There's going to be a higher value at the next anniversary date. Okay, so if we go right up to that anniversary date, I zoom right past it a week later, I can go withdraw money from a paid up additions cash value. So I'm just saying in the future, there are situations where there is no fee to withdraw. There was a fee paid in the beginning. That fee purchased something and did something positive for you.
I thought I'd share something with you this morning, and it's a result of listening to a Banking with Life podcast yesterday in my office. And of course, the jingle comes on. It's a catchy little tune, and everybody seems to like it. So I said to myself, that needs lyrics. So I took the liberty to write some, and I thought I would run it by you. I hope you enjoy it. I hope you like it. So goes something like this right here. I'm going to do it in D. There's a little old town in Texas they call Alvarado. That's where the Neathery clan can show you a plan to make your money grow. You'll learn about a man named Nash and how to bank your cash. It's called the IBC. It's good for you and me and the family. Try it, I know you will see. If you're tired of the way you've been banking your pay, you can change it. Just call the Neatherys about the IBC and they'll arrange it. Have it.
The question is, how much do you need? So,
right. Well, and two, let me say that on a couple of things you don't have the flexibility without term riders, and you don't have the flexibility in those HEC Bs.
Okay.
So you're paying $50,000 and you don't have the ability to go up and down, right? And then if I don't know that they don't, but I don't think they do. I'm pretty sure they don't. But if you were even able to put a term rider on there, they use blended PUA and term. The rider is blended. And, you know, it's just, I agree they look good. Functionally, there's got to be the perfect place for it, in my opinion, because you know, and even part of, you know, what we're talking about, looking at death benefit, cash values, and premiums, you know, we also have to keep into the equation that what the activity that you're doing is going to produce income, right? So how much outstanding in loans do you want to have at these future times when you're moving into passive income that you're going and creating?
Yeah.
You know, I'm just saying that's just another part and I know I'm going back in the conversation, but that's another component: total death benefit, total premium, the cash flows, and what you're actually financing, and passive income, right? Mm-hmm. How much in outstanding loans do you want when you get there?
Question.
Slipped my mind.
Most people rely on their traditional investments like a 401 or an IRA for their passive income comfort. Mm-hmm. And I get that, but that's why I did real estate, because it keeps paying, and this midterm is so exponentially stronger on return. That's what we're going to rely on to pay whatever policy loans that we have, and to keep funding the PUAs. And at some point, you're not going to be able to put more in your policies because you either are at the back line or you're after your 7-year pay, and you're limited then to what you can put in. But it becomes academic because here again, how much do you need? And by the time I'm 71, 72, still healthy, we're set. We're set. And it has all those attributes. Like I said, your money is safe from attack. It's like it's in a trust. You pay simple, but you earn compound. There's no volatility in it. So you don't have to worry about the market. It pays the dividend. Everything's tax-free unless you make it. There's just nothing like it out there, and it's such a liberator. It really is. It's a real tonic. And like I said, thankfully, by the way, have you ever gotten on FDIC.gov and looked at all that money that banks, the top 4 or 5 banks, put into BOLI?
Yes, many times over the years.
It's incredible. They don't want
hundreds and hundreds of millions of dollars.
That's why they have so many vice presidents in each of these branches.
And if I talk too in depth or long about AUL, because that really opened my eyes. I mean, I was a young man, and I just thought everybody should be active financially, right? And they had a great argument: buy term and invest the difference, and whole life was the enemy. And I mean, I still have these little booklets in books, and then different chapters of different books that we would use, trying to get people to agree to see what we're seeing. But A.L. Williams, and he's still with us. I understand he's drinking Mai Tais off the Florida Keys somewhere. I don't know. He sold that, right? Mm-hmm.
Yeah.
And it became Prime America, right?
Mm-hmm. Mm-hmm. That's correct.
And then you know who owns Prime America?
I do not.
Citibank. So while you're looking at the numbers of BOLI within these banks, Citibank, Citigroup, Citibank, they own hundreds of millions of dollars in BOLI, but they're telling their clients to buy term through Prime America. Mm-hmm. That's a fact.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.